This is your brain on risk. This is Mind Over Money, the podcast where Kevin Cook exposes the psychology of investing.
Welcome back to Mind Over Money. I'm Kevin Cook, your field guide and storyteller for the fascinating arena of behavioral economics. Today, we also welcome back Nathan Miller, portfolio manager for Emles Advisors. When we last sat down with Nathan, he explained to me his hedge fund background that prepared him to join Emles and develop the Alpha Opportunities ETF, symbol EOPS. This deep value active strategy doesn't go near overvalued tech stocks, unless, of course, he's shorting them. At the time in September, he didn't have a lot of shorts positions on, according to him, but he was getting ready. I titled that episode from our September chat, Finding Value in a Sea of Bubbles, Stocks to Win When the Cloud Bursts. And boy, did it ever burst, as names like Square and Shopify got eviscerated by over 60%. And Nathan was building short positions in Peloton and Tesla. And we can see how that worked out for him, too. We'll find out what else he shorted. So he was right there in the battle. He issued a bigger call to his clients and followers in November that now was the time. And his portfolio went to 30% short. Nathan, welcome back to Mind Over Money.
Thanks for having me, Kevin.
All right. So I want to talk about this, what your battle plan as it was building in summer and fall to get more short this overvalued stuff. And how did that turn into 20 companies? And, what were some of the outcomes?
Sure. So we run a value contrarian fund, and it's always difficult. It's a humbling business, but it's always difficult to short things in bull markets because the market can be irrational. And, expensive names can get way more expensive than they deserve to trade. But, basically throughout the summer last year, we wanted to take a game plan that when the cycle came to an end and when the Fed pulled back stimulus, we wanted to be in a position to essentially run, a more neutral portfolio. And so we took our exposure from 100% net long, which is typically where we ride, right? Our benchmark is the Russell 2000 index. And we scaled it back to about 70% between September and November of last year. We actually published a note for our clients. It's on our website, emles.com. The title was Be Fearful When Others Are Greedy. And in the middle of November, valuations for the market were kind of getting to what we think were, rich valuations, kind of 25 times forward earnings for the Russell 2000. And then you also had the beginnings of kind of Powell starting to do what he did in Q4 of 18 and talk about raising rates and taking away stimulus and a less accommodative environment. And our theory as cyclical investors is you don't want to fight the Fed. So the headline of the article was Be Fearful When Others Were Greedy. And we've been building a bullpen of kind of innovative, disruptive stocks that were untethered from their fundamentals. And I think in our call, we were talking about getting more defensive because valuations were frothy. But you're right, we shorted Peloton and Wayfair and Carvana, a lot of the EV stocks like Rivian and Lucid and Tesla. Basically anything that was trading at 20 or 30 times revenue was on our right down the middle of the fairway for a reasonable short when the market rolled over and when fundamentals started to take charge again. So now, ironically, we've covered virtually all 17 of those 20 short positions we've covered over the past 3 or 4 weeks. Frankly, the Russell 2000 is now in a bear market, right? We're down over 20% from where the Russell was trading in the middle of November. We're down over 10% year to date. So we think now that the Russell is back to kind of 16 times next year and 18 times this year's earnings, that's kind of a more fair valuation.
All right, yeah, and I think Roblox was another one you mentioned on your short list.
Yeah, another example of a stock that went up parabolically, and basically the fundamentals haven't even changed that much, and the stock price is off 70%. So it tells you that fundamentals were untethered from valuation.
Yeah, the market is a strange beast where, if you're just applying technicals, you're like, well, it's going up, it continues to go up and make higher lows, so everything must be fine, right?
But it helps to take a step back and look at the forest rather than the individual trees. So we have a top-down approach, and we also have a bottoms-up approach. We're not traders per se, right? I spent a long time at a trading hedge fund like SAC. We're more kind of fundamental long-term value investors. And it's the same approach that we used in the first quarter of 2020 when COVID was creeping out. And again, the market was not prepared for it. Volatility was very low, so you could hedge your portfolio. And in January and February of 2020, we actually got very bearish. We took our exposure down to about 10 or 20% from 100% net long, and managed to kind of not get annihilated as the Russell was down almost 35%. And we were able to turn around in mid-March. And the process that we use is looking at normalized earnings of companies. So when the market was freaking out saying, oh, retailers are closed, or restaurants and casinos are closed, there's no earnings, what do? The stocks overreacted. And in small and mid-cap stocks, you get drastic overreactions, right? The pendulum swings further than it should. But we're able to kind of take a step back and look at what is normalized earnings, what are we paying for the companies? And so we could run through our current portfolio and give you an example that when we're buying stocks at 5 or 6 or 7 times normalized earnings, kind of a good way to simplify it is your earnings yield, which is the inverse of your PE, is a good approximation for your expected return. So if you buy stocks at 5 times earnings, in a no revenue environment, you should still be able to have 20% annual returns.
Yeah, we talked about a lot of the stocks you hold, and we're going to get to that. I just want to look back at one thing I wrote back in September was that you saw an inflection point in the current cycle that investors could take advantage of without running to cash or without trying to time the next hot industry. And so, the way you look at picking value stocks is that these are the companies that will survive just about any economic cycle gyrations.
That's the hallmark for any good value investor is first do no harm and worry about permanent loss of capital, right? So making sure the balance sheets are strong enough to get you through any cycle is paramount.
So I want to talk about some of your key holdings, but first let's talk about the cycle. So where are we at with the economy and the Fed, and everybody's in a panic that, inflation's out of control and the Fed's going to hike 6 times this year. How do you respond to that?
Or 7 or 8 times. And I don't know. I'm sort of the camp that economists have predicted 25 of the last 3 recessions, and newspapers are made for selling stories, and so they sell fear. My argument is the Fed has always been data dependent, and they're not going to drive us into a full-blown depression. What they're attempting to do is a soft landing, which means you slow down the economy, you tap the brakes. And so my view here is it's virtually impossible for the Fed to have 6 or 7 or 8 rate hikes. The economy can't stand it. There are a lot of interest rate sensitive sectors like housing that are already down 25% year to date, or autos. And so my view is it's a lot like Q4 of 18, where the Fed came out and raised rates twice and the market was down 25%. Now we've already seen that, right? The Russell is down essentially 21 or 22% over the past 3 months, ahead of any actual rate increases. And so I think it's a delicate balancing act. But I think the key concern from the Fed's perspective is how do you get inflation under control? And so my view is inflation will naturally, you'll see disinflation, where we're at maybe 8% today. We'll get back to between 3 and 5% by the end of the year as supply chains start to resolve themselves. But there's a negative wealth effect of having stocks go down too. And so I was on the Macy's earnings call this morning, and they're already saying that the low-end consumer is much more price sensitive. So they use the example of furniture and mattresses. And Jeff Gannett, by the way, his balance sheet is stronger than it was pre-COVID. They're a company trading at less than 5 times earnings, and they just announced they're buying back over 30% of their shares outstanding. So that kind of checks all of the boxes of what we look for: extraordinarily low valuation, very high earnings yield, and great capital allocation decisions. And the balance sheet historically has been a little bit levered, but they just got upgraded today by Fitch. And they're now less than 2.5 times of leverage. And by the end of the year, they'll be at less than 2 times of leverage and able to do massive buybacks. So it's an example of the low end consumer, inflation is going to mitigate just naturally as the supply chains and the shipping delays that were caused by COVID start to abate. I don't think the Fed needs to raise rates 8 times. I think by the time they've raised rates 2 or 3 times, inflation will already be under control and back to their target rate.
And Macy's is another great example of, we talked about last time, the premature death of brick and mortar, which was greatly over exaggerated. The other thing that the market gets wrong, back to the cycle and the Fed here, is, and I strongly agree with you that just because a Fed governor says, I see 5, 6, 7, 8 rate hikes this year, it's all about the way they see the trends moving now. And in other words, the rate of change. How fast is inflation accelerating? What they can't predict is how fast it could decelerate, which would get, which makes them data dependent and would get them to rein back in their call for half a dozen hikes, right?
That's exactly right. It's the second and third derivatives that they can't easily anticipate or forecast. And as Yogi Berra said, making predictions is hard, especially when it's about the future, right? So who knows? We don't know what Ukraine and Russia evolves into. We don't know, potential issues with China or Russian sanctions. It's all unknown. And Warren Buffett says, kind of ignore things that are outside your control. And if you own companies that are in control of their own destiny, right? If they have high return on invested capital, if they are buying back stock and generating a lot of cash, you really don't have to worry too much about what the Fed is going to do. You just trust they'll do the right thing.
So last thing on the economy here, I just want to clarify for people. So when we talk about cycles and when you talk about cycles, we're not headed into recession. It's not the end of the bull market. We're just in a particular smaller cycle within a larger cycle. Is that a good way to put it?
If I put my cyclicals hat on for my days at Goldman Sachs, I would certainly say there's a risk that we are over earning. And so you look at retail spending, you could make an argument on a kind of 5-year average of retail spending that probably retail sales are above trend. And kind of our calculus is, a 13 or 14% decline peak to trough is reasonable, but the market is overly penalizing retail stocks, right? When you've got stocks that are trading at 5 or 6 times earnings, even after assuming decremental margins and assuming a 13 or 14% peak to trough revenue decline, the stocks are still trading at 7 times earnings. And these are stocks that have historically traded at 12 to 14 times earnings. So what we like to see is companies that can buy back enough stock that their earnings per share will grow and grow significantly, irrespective of what happens to the top line. And so in the Macy's example that I just gave you, they reported $5.31 for earnings this past year. They guided to $4.52 for earnings next year. However, that assumes no share repurchases. So if you just calculate in the $2 billion of share repurchases at the current share price, that turns into $6.75. And their guidance for top line is essentially plus or minus, call it low single digit revenue growth. So it's just an example where you can see explosive earnings power. And what we really play for as contrarians is we buy things that are out of favor. We wait for that earnings improvement and we wait for multiple expansion. So if Macy's is trading at 5 times earnings today and we get a 20 or 30% improvement in earnings, and we can get 3 or 4 multiple points expansion, we can double our money over the next year or two.
All right. And speaking, we'll move into your portfolio now. What many of these companies that you cover intensively are in the EOPS ETF. And another retail crown jewel, if I may, would be Signet. Tell us why you like Signet so much and why the market hates it.
They have a checkered history, for better or for worse, but they've had kind of a 3-year turnaround plan. And Gina Drosos, the CEO, has done a great job on capital allocation, some tuck-in acquisitions, but they really have a path to brilliance is the name for their turnaround plan. And they, again, have explosive earnings power. So they are printing over $12 in earnings. Stock is trading about $75 today. So that's, call it a 6 multiple. And we think the stock deserves to trade at 12 to 14 times. And, it's basically an oligopoly of jewelry retailers where they've consolidated, Zale and Jay, and they just made the Diamonds Direct acquisition. So there's 8 or 9 brands under one house. And what they've done particularly well, other than managing the supply chain and having the inventory, it is a luxury good. And jewelry really has benefited. If you just look at the category, they have survived COVID well, irrespective of the stimulus. What we would like is a pivot to online and e-commerce. And so you hit the nail on the head when you said the death of retail is greatly exaggerated. What we think most brick and mortar retailers have done well the past 2 years is a pivot to e-com and omnichannel, where they're able to serve customers where they want to buy things, which Jeff Bezos figured out 20 years ago. And ultimately, you don't have as much overhead, you don't have as much real estate. It simplifies the business model. And so everything that we own are companies that have benefited from the pivot to e-commerce, and Signet is one of them.
Excellent, excellent. All right, I want to shift to another industry, and that involves a couple of companies that you like, and that's Camping World Holdings, symbol CWH, and Thor, the maker of the RVs.
So you'll see more common themes. Thor announced a share repurchase of $250 million. They've also been doing tuck-in acquisitions, and they're trading at about 5.5 times PE ratio. Camping World, run by Marcus Lemonis, just this morning, they raised their dividend by 25% again. So the third dividend hike. So they now have a dividend hike in excess of 8% annually. We actually think it's more efficient to buy back shares, which Marcus has done personally, and he's done, they have an open share repurchase authorization, but that stock is trading at about 4.5 times earnings. So they earn about $6.65. They report after the close today. The stock price is $31. And we think, almost any way you pencil it out, that is such a diversified business model. Everybody's treating it like it's an auto retailer where they sell new cars and it's highly cyclical. And because they're selling at MSRP, and typically there's a discount to MSRP, basically they're throwing the baby out with the bathwater. They don't understand the F&I business. They don't understand the maintenance and aftermarket and repair business. They don't understand the apparel and kind of retail side of the business. But it is a diversified, new and used RV retailer. They're the largest publicly traded RV retailer. And what's unusual is their organic growth is explosive. So they're basically set out a goal. They've announced 20 different acquisitions in 20 different new stores. So they're growing organically at double digits. And so any way you pencil out, new RVs down 10 or down 20%, their organic growth through M&A, they're buying mom and pop and rolling up stores and doing new greenfield expansions. So they'll have their own RV dealer in all 48 states. It's kind of a unique situation where if it were any other retailer, and they were growing organically at double digits, it would probably trade at 15 times earnings, and we get to buy it at 4.5 times earnings with an 8% dividend yield.
Unreal. Yeah, and I want to go back to, because we talked about this before, that what are all the different ways, sources of cash flow that Camping World has besides just selling a new RV?
So, I guess what they're famous for is their Good Sam membership program. And so we tend to like companies, whether it was Costco, whether it's companies like Restoration Hardware that have a membership program, the Grade Card. Camping World's own internal program is called Good Sam. So they have millions of customers that are kind of repeat buyers. And when you pull people into your own ecosystem, right, Apple and Amazon are other good examples, you kind of get the recurring revenue customer, that there's a sense of loyalty there. There's roadside assistance. There's just a lot more that they offer their customer, and they can compete against mom and pops. And they also happen to do a phenomenal job with inventory and negotiating with the manufacturers to make sure that they had an adequate supply of RVs. It was one of the other industries that got just nailed with supply chain disruptions. And I think Camping World did an excellent job of navigating that.
And the whole RV thing is like, we saw this big spike in demand during COVID, people hitting the road. Obviously not a flash in the pan. It seems like it's this secular trend, especially as boomers might want to hit the road. Is that what you see in the data?
Yeah, there are a couple things. These are not, $200,000, motorized Class C Winnebagos are selling. These, for the most part, are, $30,000 and $40,000 trailers or tow behinds. So the business of what people historically have seen as an RV with what they actually are today is one aspect. The other aspect is you can finance it. And so typically for a couple $100 a month, you can have an RV that allows you, especially during COVID. But I actually think the argument 2 years ago was it would be a flash in the pan. It's amazing to me. They've put up 8, record quarters back to back. So clearly it's not one-time demand. You could argue it's a little bit of pull forward demand, but we've taken our model and stress tested for almost every eventuality and every permutation. And, essentially it is a secular grower. So you can look at 20, 30, 40 years worth of data, and it kind of goes up and to the right. And it reminds me a lot of commercial aerospace, where there's an underlying demand growth and people are always worried about falling off the cliff. But even if you look at 2008, I don't think that's the right analogy, right? That was really a financial crisis where you didn't have access to credit, and so you couldn't buy an RV. If you strip that out, kind of a peak to trough for the RV community looks like, 15 to 25%, which given the percentage of their business that is new RVs, it doesn't really impact their earnings that much. Kind of you overlay buybacks, you overlay their ability to pivot and convert to what are actually higher margin used RVs, they will be able to navigate any downturn. Their balance sheet is pristine. They've got a huge owner operator in the fact that Marcus owns, nearly 50% of the stock. So I'm not worried about them making it through any downturn. In fact, I think they will shine. I think there are a lot of things they can do rolling up competitors that are distressed during downturns and probably accelerate their top line growth.
Yeah, I remember when we talked last time, I put this one on my short list of like, if I'm going to start turning to value, I think Camping World is one of the ones I'm going to buy. Let's move back to consumer retail with Kohl's, because this is a really interesting story. This one was has been along for you for a while, but then we had some interesting activist action where somebody might take out Kohl's. So can you catch us up on that story?
Sure. And so I have a background in activist and retail companies, just for what it's worth. So I know a little bit about the space, but basically what we've owned Kohl's since I think the summer of 2020, when we were buying the stock at 4 or 5 times normalized earnings, and it was one of the last kind of beneficiaries coming out of the COVID stimulus era. So I think our average cost basis is about $20 a share. But the interesting data point here was that John Duskin, who runs McKellum, an activist hedge fund, he actually put out a shareholder letter. I think it was January 18th. And it was just a shot across the bow. He just was scathing reviews of Michelle Gass, the CEO. We don't really have a bone to pick with her. But the theory was that the board was entrenching themselves, paying the management team too much. And the stock was worth a lot more than where it was trading. So again, January 18th, the stock was trading at like $45 a share. John Duskin, I think, knew rumors that Sycamore and Leonard Green and Starboard Value, run by Jeff Smith, were making overtures. And so I put my hat on like a private equity investor. That's just part of the skill set is, can you rattle the cage as an activist? Can you get interest from private equity or from strategics to buy a company? And when a company is trading at 4 or 5 times normalized earnings, throwing off $1 billion of cash with a pristine balance sheet, there are very simple defense mechanisms. So, doing things like very large share buybacks, which is how they fought John Duskin off the first time. A year ago, they offered him 2 board seats and agreed to buy back $2 billion worth of stock. And then they didn't buy back the stock. And I think John Duskin was frustrated that the stock price had gone from 65 down to 45, fired this shareholder letter out after months of negotiations with the board and the management team. And so we actually added to our position. We bought call options, and a week later, it was publicly leaked that Starboard and Sycamore and Leonard Green had put in offers of $64 and $65 a share. Now today you can buy the stock at 55. I think the irony here is that the board, while hiring Goldman Sachs and PJT to run a strategic alternatives process, immediately put a poison pill in place, making it impossible, or making it way more challenging for a hostile takeover, and then rebuffed. They shot down the 2 offers. So rather than publicly engage in a process, they kind of entrenched themselves and set themselves up for a very ugly shareholder fight with McKellum. And so, look, the fact of the matter is they're going to put out new updated long-term guidance. They've claimed they're well ahead of plan, and judging by their comps, they should be. The critique from the shareholder, from John Duskin, is they didn't buy back the stock they promised they were going to. The stock is so cheap that shareholders would be better served with, kind of a $2+ billion accelerated share repurchase. And they haven't publicly given us, their growth plan, their outlook. So we'll get that the first week of March. I think that's the next catalyst. Duskin he's already nominated a slate of 10 board members. And I just think you have the possibility for, there's been rumors of Amazon, but I think you have a very high possibility that one of the 3, or maybe 2 of the 3 bidders come back with a dramatically higher price. And that's typical, right? In the sales process, you typically see a company turn down an offer And when it's a multiple bidder situation, they turn down 64, 65 because of an inadequate premium. But it's hard to turn down 75 or 80 or $85 a share. And the math
Which is what you think it's worth, right?
Duskin has said publicly it's worth $100 a share.
Okay.
So the viewpoint is, Coles uses that to say, well, if you think our stock is worth $100, why should we sell? And then the rebuttal is, well, it's not worth $100 with you guys managing it. It's only worth $100 if you start to do things like large accelerated share repurchases. So again, it's a nice little activist campaign.
And when you mentioned the poison pill, is that just they place a limit on what activist or passive investors could own as a percentage of the company?
That's exactly what they did. And it's a little bit unique because they stopped activists from owning more than 10% of the company, and they stopped kind of long only plain vanilla passive investors from owning more than 20% of the company. But what's a typical phenomenon is what's called a wolf pack attack. So there are probably 5 or 6 different hedge funds that are under a 5% filing requirement. They're not acting in coordination or acting in concert, but they all have, brains, and they can figure this out themselves. So they tend to work, buying up under the 5% threshold so they don't have to do any filings, and exert a lot of pressure on the board to sell the company. And
Gotcha.
So my theory is they better come out the first week. I think it's March 7th or March 9th. They better have a really good excuse for how they're going to get the stock price dramatically higher over the next 2 or 3 years.
Yeah, because 4 or 5 wolves in the wolf pack is 25% of shares, right?
That's exactly right. And I think this is a case where ISS and Glass Lewis, the proxy advisors, who frankly a lot of the passive investors just follow their advice. This is a fact pattern that is ugly enough that ISS and Glass Lewis may say change is warranted. You need to elect more of John Duskin's nominees and not support the incumbents. And we can go into the details, but there are a variety of reasons where this looks like an entrenched board. It looks like a board that is protecting themselves despite owning virtually no shares of stock. They're looking out for their own interests rather than looking out for shareholder interests.
The details are mostly over my head, so I'm going to stick with the flashy headlines like where did the Amazon rumors come from?
Look, I do this too because I started my career as an aerospace analyst, but the Coles private jet, which is a Challenger, flew to Seattle. Now, granted that Michelle flies all over the country to visit stores. The timing is what's suspect. So she flew to Seattle, and within 24 hours of returning, their board had put out a press release stating that the offers they had at $64 and $65 were inadequate. However, they still retained Goldman Sachs and PJT to run a process. So it's like, how, on one hand, we don't want to sell, but on the other hand, we're hiring bankers. Well, you only need bankers if you're planning on selling. So it's a funny fact pattern there, but the timing of it was suspicious.
All right, Nathan, thanks for that deep dive into some of your core top holdings. Let's talk about your outlook for the year. And one thing you sent me this morning, your chart of the Russell 2000 PE and where you think it might be attractive again. And for do the best you can on just a podcast here of illustrating that for our listeners.
Sure. So essentially, we use the Russell 2000 as a barometer for small and mid caps. That's basically our benchmark. And the valuation is the lowest for our index that it has been since March of 2020. You're getting to buy stocks at the cheapest price to earnings ratio at any point in the last 2 years.
Since the trough of 2020,
That's correct.
What I call the Corona crash?
Correct. So when you chart forward PE estimates for the Russell 2000, it comes out to about 16 times next year and about 18 times this year's earnings, which, we were north of 25 multiple 3 months ago in November. So the multiple has come down dramatically. Now, over the course of 2021, we actually started the year at a 30 multiple, but earnings grew so fast for small and mid cap companies. I think earnings were up over 30% last year, that the multiple came down throughout the year. And then the stocks rallied in November. The multiples got a little bit exaggerated. That's when we put out our flash report in November saying, be fearful when others are greedy. We're on the other side of that today, right? With the bear market, now is actually the time there's, quote, literally and figuratively blood in the streets. Now's the time you want to buy when there's kind of peak fear. And so we're getting to buy a benchmark at 16 times next year's earnings. But we kind of peel the onion and we can find companies at 5 or 6 times earnings, which once you factor in their buybacks, really companies trading at 4 and 5 times normalized cash flow or normalized earnings. And again, the kind of shortcut or the trick I told you is if you can buy an index at a 16 multiple with no revenue growth, which we think is not true, a 16 multiple should throw off, high single digit returns. So we're actually pretty bullish right now. We've taken our net exposure to the highest we've had it in over a year. So we're running about 100% net long. And we came in pretty well hedged through November, December, and then started covering all of our shorts at the beginning of January, and basically finished covering all of our shorts over the past 3 or 4 weeks. Anybody that's been paying attention has seen the Ukraine-Russia coming. I think the jawboning by the Fed, all they care about is stopping inflation. They don't really care about, their goal is not to cause a recession. Their goal is to get back to a kind of 2 or 3% inflation rate. So the market can help get us there by a negative wealth effect. The market seems to be naturally slowing down. You're kind of anniversarying things like stimulus checks and the loss of child tax credits. So there's kind of a natural disinflationary tendency. And you've also got supply chain that's starting to ramp back up again. So we're pretty bullish that inflation is temporary. And within the next 6 to 9 months, inflation will be a lot closer to 3% than 8%.
Is your 2022 outlook, is that available on the website at emles.com?
It is. We published that a few weeks ago. It's the 2020 annual outlook, and it is on Emles. There should be a section called Insights, and if you click in there, you can see a lot of the materials we've written. I think our audit is on the website. We've got some videos that walk through each of the strategies. We've got a total of 6 ETFs. So one of them, for instance, is the ticker FEDX, which is a government services ETF. Layman's terms, it's a defense contractor index.
I was going to say Lockheed Martin.
Exactly, Lockheed and Northrop. And so one of the nuances here is it was also about 6 or 8 weeks ago that we started getting long Lockheed and long Mantech. So part of what we do is event driven. So we own Lionsgate because they're spinning off Stars, and then we think the entire company is in play. We own companies that are at a higher probability of getting taken out or higher probability of just selling themselves like Kohl's. We own companies like Mantech, where George Peterson is the founder and majority shareholder, that he's at the stage in his life where he needs to deal with estate planning, and there's a super voting issue. So we own a lot of defense contractors that have rallied dramatically. If you pull up a 3-month chart of Lockheed Martin, the thing is up 20% or 15% in the same time period that the Russell 2000 is down 20%.
Right.
And so defense stocks are negatively correlated during times of crisis. It's kind of a weird sector. Having been a defense analyst, very few people realize that defense outperforms the market the vast majority of the years. It has a lower beta and a lower volatility, much better kind of peak to trough drawdown phenomenon, and it acts like a shock absorber. So when you have geopolitical crisis, defense stocks go up. And the immediate thought that comes to mind is, well, what happened on 9/11? And it's the same scenario. Defense stocks went up 15 or 20%. The entire market went down 5 or 10%. And so it's just kind of a nice negatively correlated asset class. And so that's why we launched FedEx, FEDX.
Yeah, you talked about this when we last time in September, and it was a mystery to me then. Like defense stocks for defense, but it's you've watched it evolve over the past 2 decades, so you know the data. Well, Nathan, it's been another great conversation with you, and I want to do this like every 4 or 5 months just to catch up on the battle between value and overvalued tech and how it all sorts out in an economy that is still, firing on plenty of cylinders, right?
That's the irony here, is everybody assumes we're in a recession when the GDP readings are, high single digit. We're a long way from a recession. And generally, you don't get strong consumer spending in a recession. So we look at the fundamentals. We have the luxury of looking at, earnings and cash flow and not believing the hype. So it's a humbling business, but hopefully, knock on wood, 3 or 4 months from now, we can have a follow-up conversation and do a victory dance.
Yeah. All right. Thanks, Nathan.
Thanks, Kevin.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.